Hello, welcome back everyone. So let's complete the remaining part of reading 20, everyone. Now in reading 20, we have to do the financial reporting standards and things related to that. What is the objective? What are the need? What are the importance? And we have discussed the standard setting bodies. So if I were to just recollect, standard setting bodies, these are bodies of professional, these are organizations of accountants who basically accountants, not only accountants, but auditors as well. They will frame the accounting policies. They will, put up the accounting standards based on which the companies will report them. And regulatory authorities they are the government agencies. They will ensure that everything in the capital market is complied as per the law, and investors interests are protected. That's what their objective is. So regulatory authorities are going to be the ones who are going to enforce the compliance. Standard setting bodies are the ones who are going to come up with the standards, come up with the compliance, and regulatory authorities are going to ensure that they are followed. So we discussed about that in the last topic. And for example, since our course is more focused on the US, we discussed from the SEC's angle, what are the major forms or major filings that the companies have to do when they are listed, right? Similarly, you have different types of listings in Europe and other parts of the world, but major focus is going to be on the SEC. But before that, what is the objective behind coming up with a financial reporting standard? Now, remember one thing, that the International Accounting Standard Board, the major objective is to communicate with the investors, communicate with the stakeholders. That is to provide them information not only about the current situation, but about the potential situation that the company may face. This is a very important information for investors, creditors, and everyone who is going to be associated with the company or who are going to give funds to the company. So they want to take up a decision whether to invest in the company or not. And that's where they require a detailed and a proper, or rather I should say, systematic information. That's what is being ensured by financial reporting standard. That is the objective. Communication or information to the stakeholders. That is the objective. Correct? Now, why do we have a common standard here? Well, the basic importance is that if we just leave it to the companies to do it, every company will have different way of presenting it. So since every business is different, every company size is different, every company stage is different, if we don't set up a standard, what will happen, guys? There will be no uniformity. There will be no uniformity, and it will be very difficult to compare between two companies, because two companies can be very much, they may vary too much in terms of their sizes and other things which I mentioned. So due to this, we need to have some consistency, and we need to have some common measurement, and that's why we have a financial reporting standard. So every company reports in the same manner. So the basic objective here is to provide consistency with the help of this financial reporting standards, right? So how is that going to help me? Well, the biggest I should say biggest advantage of this is that it's going to give me a easy way to value the company. It's going to give me a valuation aspect, not only for one company, but I can compare this valuation for various companies. And that's the biggest advantage of having financial reporting standard. It helps you in decision makings, right? Also, it helps you that if I have done one transaction, so that same transaction is reported in the same manner by the other companies. So that allows less discretion to the management, right? If there is no reporting standard, then management may do it in their way, and therefore there can be problems. So in order to avoid those misstatements, or in order to bring more consistency, we have the financial reporting standards. Correct? And then there is one part which is going to be more of a self-reading, and that is going to be the conceptual framework. What is the conceptual framework? The conceptual framework as per the accounting standards is basically going to tell you that what should the financial statements or financial report consist of. It should have some qualitative characteristics, and those qualitative characteristics is that they should be relevance and faithful presentation. Whenever I say relevance, it means materiality, or relevance means all those informations which are necessary for an investor to make the decision about the company. Those are information are called material information. That information or relevant information through which you and I can make a decision, all that information should be present. That's the point of relevance. Second, these information should be complete, they should be unbiased, and there should be no error. That's called faithful presentation. So this information should be complete, there should be no bias in reporting, and it should be free from error. Of course, who's going to check this? Auditors are the one who are going to check it, right? So when it comes to two qualities, relevance and faithful representation, these are the most important qualities that should be, they are called qualitative characteristics of the financial statement that should be there in any financial statement. Now there are 4 characteristics that enhance, that adds on to this quality. 4 characteristics that adds to this quality, which is relevance and faithful representation. So what are those 4 additional things? That is comparability, verifiability, timeliness, and understandability. Why am I discussing this? Because this is asked in the exam a lot of time. So comparability means financial statement should be consistent among firms and across time periods. So when I look at the financial statement between companies, I should not find it complicated to analyze. I should not find it complicated when I'm comparing this year's data with the previous year data. So it should be easy to compare. It should be easy to verify. So let's say another analyst does the same method which I do. We both should be able to verify the numbers. That is called verifiability. The third is timeliness. It means the information should be presented on time, not when it is done, not when the information is stale. The objective of financial statement is to give accurate and not only accurate or precise, but rather it should give you information on time, not after when things are done. So that is timeliness. And understandability is that any user with a common knowledge, basic knowledge, should be able to understand the financial statements. For example, in the income statement, when we do multi-step, anyone can understand the multi-step format, that it starts with income, then the expenses, and then you get the net income. Similarly, when you see common size income statement, you can convert everything into percentage. So that's very easy for any type of person to analyze. Whether the person comes from the accounting background or not, any person should find it very easy to analyze. And that's the very important enhancing characteristics of the financial statement, that it should be understandable, it should be easy, and it should not be overcomplicated. You should not omit some information, and you should not put some extra information and make it complicated. It should be easy to understand. Clear? You should not, with some minimum effort, you should be able to understand the financial statement. That is the major objective here. That is the qualitative characteristics. So 2 characteristics and 4 enhancing characteristics, right? This same characteristics you'll see at the bottom also. At the bottom, they have again mentioned general requirements. In that, you will see the general features. Here, you'll see the same types of qualities repeating again, right? We'll see that later on. However, you also have to understand that there are some constraints while preparing the financial statements, and that constraints you need to recognize. What are the constraints? The first is the cost-benefit trade-off. Cost-benefit trade-off is that you want to present all the information, right? But that information should be useful. It should not happen that the cost of information is greater than the benefit of information. So you should always put up that information where the benefit of that information is more than the cost. That should always be the objective. So the users should benefit more from that information, and the cost of presenting that information should be relatively lesser than the benefit, right? That's what we need to ensure. Second, you need to recognize the fact that not everything can be captured in the financial statements. For example, very important example they've given here is brand loyalty. Now we know in India, companies like in India, we have Tata Group, where the employees are very loyal to the brand. They have a different, I should say, a different feeling that they get when they join companies like Tata because of the ethos of the company, right? So the brand loyalty is a very intangible aspect which cannot be captured in the financial statement. It's not goodwill, it's a brand loyalty. Some people like the brand so much that they are willing to buy any product from that brand. So employee loyalty or brand loyalty or various things, the reputation of the company, these are, or as mentioned here, the capacity to innovate, all these are not captured in the financial statements, right? And therefore we need to be aware about these constraints. Clear, everyone? The assumptions, what are the assumptions here, guys? Accrual accounting, everyone aware? Cash accounting and accrual accounting, we do financial statements, we prepare financial statements based on accrual accounting, which is when the things accrue and not when the cash is received or paid, right? Similarly, there is an assumption of going concern. What is the going concern assumption? That the company is going to continue in business in the future. It's not going to shut down. If it's going to shut down, then there's a different way of presentation. Correct? So two assumptions. Which one two, guys? Accrual accounting and going concern. Right? And if you remember from revenue recognition, you recognize the revenue. You recognize the revenue when you expect to give the service or provide the goods. Basically, anyone who is going to get the goods or service, they are going to get some future benefit from it. So they are going to get benefit in terms of the product, but you are going to get benefit in terms of some money. So anytime if there is a future economic benefit from the item, then you recognize it. So an item should be recognized in the financial statement only when a future economic benefit from the item is probable. Probable, which means, let's say I buy a machine. Should I record it? Yes, because by that machine, I can produce goods and I can sell them and probably I can make money. Now, it should be probable that I should be able to make money, and you should also be able to value or measure the cost of that item. So I cannot say a machine which I'm not aware about its cost. No, I should be aware about the cost of that machine. I should be able to measure the cost of that machine. Only then I should recognize. You cannot recognize something that you're not aware. You cannot recognize something that is vague. So first, there should be a probability of it happening, probability of getting future economic benefit. And second, you should be able to measure its value or cost. Only then you recognize in the financial statement. Clear, everyone? Also, one more thing, on the balance sheet or income statement, especially on the balance sheet, when you buy assets, do you recognize all the asset only at historical cost? No. There are some assets which you record at historical cost, some at fair value, some at net realizable cost, and so on. So there are different measurement bases used for recognizing an item on the financial statement. I'll repeat, there are different measurement bases used for recognizing an item on the financial statement. Let's say I buy a machine today at $1,000, or I had bought a machine 10 years back at $1,000, or I can say rather $100,000. This is called as my historical cost. This is the cost at which I bought the machine in the past. Clear? Now let's say 5 years have been passed and every year the machine value is depreciated, isn't it? So at the end of 5th year, what is going to be the value of machine after depreciation? That is called amortized cost. What is amortized cost? Historical cost minus the depreciation or amortization or any fall, which can be depletion or impairment. So amortized cost is actually the cost of the historical cost minus any fall in the value or allocation of cost and so on. Everyone with me? This amortized cost is also called as carrying value. Everyone with me on this? Remember, this amortized cost is also called as Carrying value of the asset. Clear? Now, I had bought this asset 10 years back or 5 years back. If I have to buy it today in the market, what would be its cost? Its cost can be higher or lower, both, right?
Yes.
That is called the current cost. Current cost is the cost at which you may have to pay in case if you're going to buy it today. So it is the amount that you have to pay today to buy the asset. Is that clear, everyone? Net realizable value is the value that you will get if you realize the asset today. If you sell the asset today, let's say you have a machinery which is old. Now, if you sell that machinery, you may get only, let's say you will get $75,000 and you will pay 5,000 as a cost for commission for someone to sell it. Then the net realizable value that you get is 70,000. So what is 70,000? This is called NRV. Net realizable value is selling price minus selling cost. So this is selling price minus selling cost. This is called NRV. Remember this. This is one of the most used term which you will see in the later on topics also. Clear, everyone? Present value is simply the discounted cash flow value, which you also saw in time value. So all the future cash flow, when you discount it at the cost of capital, you get a present value. And fair value is a value that if you sell this to a willing party, to, let's say if I sell this machine to someone else who also operates the same machine, how much will I get on this? So fair value is the price of the asset if the asset could be sold or liability transferred between the willing parties. So if I sell this machine to someone who uses the machine, not in scrap, how much is the value that I may get today? That is called fair value. Normally, fair value and NRV are very close. These two values are close, everyone, but may not always be same. So there are different terms used in the entire syllabus of FRA. We will come back to this point again when we do long-lived asset, because on the balance sheet, you may find the value of asset at historical cost, amortized cost, which is after depreciation, current cost if you were to buy it today, NRV when you sell it, and how much do you recover net. Present value is the estimated value of future cash flows discounted, right? This is an estimation. And fair value if you sell this asset between the willing parties. If you sell it to someone else who also does the same job, how much will you get? These are the different measurement ways. Everyone clear with this? Correct? Then you are aware about the financial statements which we are going to require. That is balance sheet where you have assets and liabilities. You have statement of changes in equity. Then you have income statement where you have income and expenses. These are the major financial statements. And then you also have the cash flow statements. So these are the required reporting elements of financial statements. You can just simply go through it. What is asset? What is liability? What are income and expenses, and so on. Clear? The same is presented in a detailed form. What are the required financial statements? What are the features which we just saw, the characteristics? And structure. Structure can be a classified balance sheet, or it can be an income statement, multi-step or single step. Classified balance sheet. Balance sheet also has presentation, like income statement presentation, you had single step and multi-step. In balance sheet, we'll also see the presentation type. In cash flow also you have a presentation type. So all that we'll be seeing in the next topic. All that, how the structure of financial statement should be, that is what they have mentioned. And if you want to read in detail, I've mentioned things in detail as well. You can just go through that, right? Finally, you're going to compare IFRS and the other reporting standard, especially here in the syllabus. Your comparison is going to be majorly with US GAAP, correct? Now, US GAAP is more rule based. There are strict rules in US GAAP. IFRS, I generally say IFRS is more flexible because IFRS is principle based. You have more choices in IFRS than US GAAP. Okay. For example, what we've done till now is inventory valuation. If you remember, in inventory valuation, LIFO is not allowed under IFRS, but allowed under US GAAP. And because LIFO has its own problem of deflating profits for not paying taxes, all this is not allowed under IFRS. So IFRS is more principle based, right? Ethics based and so on. You just saw one adjustment of extraordinary item recently. Where is extraordinary item recognized? As per whom is there something extraordinary? Only US GAAP, right? IFRS says there is nothing extraordinary. Am I correct?
Yes, sir.
Yes.
Extraordinary is something which is unusual and infrequent, both. Only recognized under US GAAP, not under IFRS. Similarly, there are several differences that you will see. For example, these two you will see in the later topic. Development cost is going to be with regards to software and other assets. So this is what you're going to see in long-lived asset topic. This is what you're going to see in the inventory topic, not now. So all these adjustments, there are minor adjustments which are differences. They have just shown you a few examples here. Remember, US GAAP follows Financial Accounting Standard Board, and globally we follow International Accounting Standard Board, IASB. Now, how will you as an analyst be aware about this? If you are a chartered accountant, of course, it's your daily job. But if you're not an accountant, how are you going to be aware about this? So you have to monitor these changes which are happening in the accounting or auditing or taxation field, so that you are updated about it, and then you can prepare your reports accordingly. So how can an analyst remain active or aware about all this thing? They have said that the analyst should monitor all the new products or transactions which keep on happening. For example, I will tell you, there's a lot of discussion about how to recognize the investment in Bitcoin. If the regulatories are not allowing it, but if I've paid money for it, what should I show? Should I show it or not? What should I do? Correct? If you remember, there was a news about a guy from Singapore with an Indian background. He bought a $70 million digital painting, digital art, I should rather say, $70 million. So which is a digital art. It's stored with a Bitcoin code. $70 million he paid for it. And that art is going to be, so these are new types of transactions that are happening. How to recognize these transactions, how companies or accounting firms would be doing it. You should be aware about it. You should read about it because they may have implication in the future. Today, recognizing Bitcoin will be uncommon, but by you must have read news a couple of a week or months back where Tesla decided to buy Bitcoins and accept Bitcoins as payments and do the transaction on Bitcoins, right? So gradually, if all the tech companies start accepting the payments in Bitcoins and all, then we will have to understand how this transaction should be recorded and all. Am I correct, everyone? So you should monitor all these upcoming things. Second, they have said that you watch out for actions by the standard setters like FASB or ISB when they come up with a new standard, or when there is some announcement by SEC, or they have also said CFA Institute does this regularly. So if you go to the CFA Institute portal, you subscribe yourself for their newsletters and all, so you may get new updated information about what's happening in the financial markets. And of course, you can also look at company disclosures, because in the footnotes and disclosures, if there is any change in policy, if there's any change in estimation, if the company has added few things, you can always find in the disclosures. So all these are important sources of information for you to understand for any major developments which are happening in the financial reporting standards. Clear, everyone? Right? That's it with reading 20. So we are done with reading 19, 20, and 21. And yeah, that's it. So we'll complete the session here today. I'll open the session for doubt session. And after that, I'll also, in between, I'll also discuss something with regards to how your preparation should be, which of course I've discussed in the last session. So that's it for the day. If there is any doubt, let's take that. Or if you want, I'll just quickly discuss what you should be doing. That's just gonna take a minute, and after that you have any doubts, you can let me know. So guys, what I want from you all is that we'll be now completing FRA relatively faster than the QM topic, and now things will happen faster. So I've also messaged you all that do read our notes, do repeat our notes, not in the class, but after that, give more time, do read other sources, like you have Kaplan Schweizer book with you. You want to read that, you read that. That's going to be a good thing. But the more additional things you read, the more effort also you'll be requiring. Okay. And then also give the tests. All this will be a good combination for you to clear CFA. Don't worry about that. So just follow the process till the last. Follow. Repeat the same process. Okay. That's it. Now that's it for the day. That's it from my part with respect to the teaching aspect. Now I'll open the session for doubts, if any. If no doubts, we'll meet in the next session, right? So anyone who has doubts can wait. Those who do not have doubts will meet in the next section. Thank you.